You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the network for you, the busy financial advisor and asset manager. You're out there, you're dealing with your clients, you're managing those assets. Maybe you don't have time to catch up on the latest education in the world of options and derivatives, as well as what the heck's going on out there from an overall trend and breaking developments perspective out there in the world of options. Don't worry. We got you covered here on the show. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which so many of you are binging these days. Hope you're navigating these rocky market waters. Of course, you have a lot of great content to help you do that. So make sure, A, you're listening to the full network, and B, if you want to go above and beyond, join us on the pro side where we tackle a lot of these issues in a lot more detail. theoptionsinsider.com/pro. The place to go to learn more. As we go around the horn, see who's joining us out here today. First, let us go out to the shores of Maine are dark and stormy. I don't know if the limited shoreline of New Hampshire can be described as dark and stormy, but nonetheless, we are joined from there once again, all, I think, 9 miles of coastline that they have, by our old buddy, Mr. Matt Amberson from ORATS. Mr. Matt, how are things on the secret shoreline of New Hampshire, sir?
It's actually beautiful. I talked to a New Hampshire registered investment advisor today that listens to the show, and he was want to hear how you describe the New Hampshire's seacoast. So we have to come up with something a little more catchy.
The secret shores of New Hampshire. There we go. No one really knows it exists.
I like it. It's a beautiful day today. Spring is in the air. It's just it's gorgeous out there. The waves are beautiful. Offshore winds. Went for a walk with the dog to get prepared for the show mentally. So I'm ready.
The folks in New Hampshire are going to like me a lot more than the Maine Tourism Board, shall we say. I've been describing their shores as dark and stormy for years. They don't like that. But the folks in New Hampshire, the secret shores of New Hampshire, I don't know. It's got a certain ring to it, a certain pizzazz, certain alliteration to it. I would go to the secret shores. And hey, reminds people that, hey, New Hampshire has a shoreline, all whatever it is, 8 miles of it. It does exist. As we keep on rolling right on into the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, let's get right into it with the P&L statement, the segment that was born of the dark days of the pandemic because so many just insane, unprecedented things were happening on a pretty much weekly basis that we spent a good chunk of the start of every show just talking about what the hell happened in the options market since our last show. Now it's become part of the show, which is the P&L statement. And again, a lot popping off out there. We wanted to get the show out to you early just because there is so much going on out there in the markets right now. Of course, we know a lot of you tune in for what's going on right now. Also, a lot of you, there's a strong evergreen component, obviously, to this show. So a lot of you come back many weeks, months, and years down the road. So in that case, you can always just think about how to apply this to whatever market environment you're in. Maybe you're in another higher volatility environment, in which case this will certainly be music to your ears. Either way, the market's undergoing a little bit of a tumult right now, I think to put it mildly. We were selling off earlier in the week, then the market tried to rally, and then, of course, the news breaking, not even news, just the rumor breaking that Iran was going to attack Israel heading into the weekend. That sent vol skyrocketing. It sent the markets plummeting. And even though the attack was somewhat mitigated over the weekend, we thought maybe coming in yesterday we'd see a nice rally. Didn't really work out that way. Turned to the dark side. And as we're coming in today, vol is still elevated. VIX cash at about an 18 handle right now, which is substantially higher than it has been in a long time on the show. We actually threatened a 20 handle earlier this week. Got up to about 19 and a half earlier, 1956 to be precise, just this morning actually. So yeah, a lot of vol on the tape out there. Even the markets are struggling to maintain unched right now. They vacillated between a little bit red, a little bit green out there all day. The S&P, though, giving up a lot from its highs. It's right around 50 and a half right now, where, of course, it was far north of that, threatening 5,200 and beyond not too long ago out there. Of course, you look back in the rearview mirror, we also are still a long way above the 4,100 level that we were right around Halloween of last year when the Fed really kicked markets into high gear. So a lot to unpack out there, Mr. Matt. Obviously, looking at a different vol level right now. So I know a lot of our listeners want to know, A, what are your thoughts on this vol regime? Are we in a new vol regime, or is this just a blip? And then B, I know you've been a little bit more, shall we say, skeptical of this rally than a lot of other folks out there who've been just kind of buying this with both hands. Are we back to the, I can't say 3,000 before 5,000 anymore because we're north of 5,000. Maybe 3,500 versus 5,500. Is that the new poll for you, sir? How are you feeling about these levels?
Yeah, I mean, maybe not the best of the longer term stuff, other than it's just right now the shorter term signals have finally turned a bit bearish. I do think we're in a new vol regime. All the way through the uptrend, we were pretty bullish as you could go back on the shows, but I just still didn't like the overall market. But we relied on our short-term signals, and now they've turned. When vol is so low for so long and then it pops out, it's going to take a while to shake out. And you could see how jittery the markets are, even today, yesterday. That they'll kind of recover, then come down real fast, and then up, and then bang. So yeah, that usually tells me that there's more going on. There's a lot of jitteriness. Still there's a lot of buy the dippers and a lot of cash, around out there. It's hard to be real negative on the market when it's gone up so far. other than, the Bears have had a chance to get a few percentage points on the downside here. No secret that I'm a little bit bearish. So, what I've been doing lately is out of the money calendars on the upside. So that's going to save me a lot of days. It's not too expensive to buy those. So, and they pop when they pop, but then, I have those out of the money put calendars and put diagonals that have performed nicely. So, you get paid, and it's a heart attack versus cancer, I guess, is a not very eloquent way to say it. On the way up, it's chipping away at you, but on the way down, you make the money. So yeah, that's what I've seen in the markets as far as just the structure and the shape of the market. We have seen some slope come back. It's no secret that I think that the 0 DTE has changed the structure of the market. For the good. I think really it's added, as a past market maker, it's really given the market maker a reprieve from being so short the lower strike puts, and you could see what I'm saying in what we call our slope reading, or the slope of the put call skew has flattened out quite a bit. And even though it's gone up in this last sell-off, it hasn't gone up nearly as high as we used to see it. We do a measurement that every 10 delta points, we usually saw the lower strike about 8% in IV terms higher. Now it's only 5-4%. So it's significantly shallower of a skew. The put sellers don't like that, but I think it makes for a more orderly market, and that's what we're seeing now. It's come up a little bit, as has vol, but that's what I'm seeing right now, Mark.
We just put the question out to our ultimate arbiter, Mr. Matt, our audience out there. We raised your level a little bit for you, though. 3,500 or 5,500. That's what we put out to the audience on a flash poll. So we'll see what they have to say. Which one do you think we're hitting first, Mr. Matt? Where are you leaning? You still leaning back on the Bears side? You think the Bulls are going to take it back to 5,500? What do you think, sir? What's next? What's first?
I mean, I'm twice shy to make that call. Obviously, we're a lot closer to 5,500. But I take a bet. I take a ratioed bet on that. I think it's, if in the market, it's probably a 5-to-1, 10-to-1 shot. I'd probably be a buyer of 7.5-to-1, but not even odds. But I am a bit bearish out there. For a lot of the macro things that you've talked about before, it does seem to there seems to be a lot of contrived things happening in the markets. Unfortunately, a lot of these congressmen are trading and making a lot of money. And they still seem to be long. They seem to know what's going on. So it's hard to go against the big boys behind the screen. But it does seem, for the short term now, definitely our signs have, for the first time in a long time, turned bearish. So let's say short term bearish, Mark.
Interesting. Right now, with 2 minutes down in our flash poll, Mr. Matt, and 2/3 of the folks are leaning with you, bearish, 3,500. Only a third going to the upside, 5,500. Of course, this will be live throughout the duration of the show, listeners. So get out there. You should be following us at Options on the old Twitter/X anyway. A lot of fun stuff like this going out every day and throughout the week out there. But a fun little flash poll. See what you folks have on the brand. Our audience tends to lean a little bit bearish anyway, so I wouldn't be surprised to see them lining up behind you, Mr. Matt, on the dark side. Maybe they want some odds too as well. We didn't offer any, but maybe they want a little bit of ratio odds as well. You mentioned the skew out there, Mr. Matt. The other thing everyone's really kind of debating right now, as I mentioned earlier, VIX cash threatening a 20 handle. We have to go back a ways to really see VIX vacillating around and threatening a 20 handle again out there. So a lot of people flummoxed, shall I say, by these recent levels. 1956 this morning. Haven't seen vol this high in quite some time. A lot of our newer listeners, they don't know what to do with themselves in these vol levels, Mr. Matt. So what are your thoughts out there? VIX vacillating around 18 to 19.5 right now as we're talking. You think, again, is this just a short-term aberration given all the geopolitical concerns we're seeing out there? Or maybe are we kicking it into another gear? Dare I say it, a higher volatility regime, sir?
Yeah, like I said, I think this is for real. And, so one of the things that we do, obviously we do a lot of back tests. And we do back tests in certain environments. So we've broken down the environments out there a number of ways. So the VIX has 3 breakdowns: below 15%, 15 to 20, and above 20. So that's kind of all those have kind of equal buckets. Now we're in a moderate one, so we would only back test strategies that occurred when the VIX was between 15 and 20. So you might get, a third of the time for that. We do RSI oversold, an IV percentile. By the way, the IV percentile is now high, and the slope percentile is now high. That slope that I talked about, even though it's low relative to where it usually is, it's high. And if you look at the best strategies, how the best strategies have performed under these different environments, so of the 65 million tests that we've run, kind of the best ones are you see some odd strategies. Usually you'll see, short put, spread, calendars, but now we're seeing long straddles, if you can believe that. So our back tester, naive, but still for these environments are picking a straddle. So it just, I think what our back tests are showing is that look in the market it's twitchy to me. It moves a lot. And it moves fast. It's kind of if you're not watching, it's a kind of a, like, what just happened here? So, when I think about markets like this that have, broken down after a long period, and we look at, a number of things, but we look at the components of the market-wide SPY, QQQ versus the underlying, and how is vol moving? And when you look at it that way, you see that most of these kind of predictors have broken down and turn bullish. Like what you want to see, if you're long, you want to see vol kind of trending sideways or going down. I mean, we've popped and we're staying above moving average lines. The SPY implied volatility is now quite a bit above the components. So even though the components are going up, the SPY is moving up faster. And these are all bearish. And it looks, these are signals that aren't just daily signals. These are weekly signals. So it does seem like a kind of we've entered more of a bearish kind of looking market. We'll get some face rip-off rallies, but I'm going to say overall it does look a bit bearish out there. However, it's tough to bet against this market, but for now it looks pretty bearish, Mark.
Yes, it does. And speaking of things that move quickly, Mr. Matt, our poll swinging the other way now, 62.5% going to the upside. So they heard your call and they have responded to the upside, saying nana nana boo boo to you. 62.5% saying 5,500 for the S&P, 37.5% right now saying 3,500. Of course, that is the closer of the two. So I do expect that to take it in the end. But intriguing stuff. Speaking of other questions of the week, other hot topics we're debating right now with our audience, Mr. Matt, I want to kind of get your thoughts on it as well. Obviously, outside of the last few sessions, the market has mostly been in rally-ho mode for over a year, and certainly from last Halloween in particular, aggressive rally-ho. So we thought we'd ask our audience quite simply, what is the biggest driver of this rally? Only gave them two choices and the infamous other. The Fed, of course, and the other one everyone is always talking about, the AI revolution, and then, of course, the infamous other. And we've got some others out there. But right now, over half, Mr. Matt, 54.5% going with the Fed, 36.4% saying the AI revolution, and 9.1% for other. Mr. Matt, so where do you fall? Or maybe do you have a surprise other for us, sir?
No, I think that, I think the Fed, especially in an election year, are really going to rally behind Biden and try to pump up the market as much as they can, fudge the numbers. They talk tough against inflation, but inflation just seems to be right there. So they are having a tough time with it. And anyone who goes to the stores, anyone that's bought anything, you can't hire anyone. My son is graduating from high school, and they have like 100 different job opportunities. I remember when I graduated in a recession, there were very, very few job opportunities out there. And now, like the labor market's super tight, prices are high. The Fed's going to have a difficult time, but they still just keep inflating. They keep doing things just to get cash out there, and I think that has buttressed the market. So I think the Fed is really the big one there. I agree with our listeners, Mark.
Yeah, I thought it'd be even higher for the Fed, but right now, roughly half. Again, make your voice heard at Options is the place to go. As we keep on going into our next segment, it is time. Speaking of vol, it is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report. Another segment kind of born of the pandemic because we saw so many weird things unfolding in the world of earnings volatility. We had to codify them in their own segment, and thus the Earnings Volatility Report was born. Matt, another reason why we wanted to get this show out a little earlier this month is because we are right back in it. Earnings season popping off as we speak. It really started in earnest last Friday, with a lot of the financials popping off, and has since kind of gotten rolling from there. Many more financials. We had Goldman earlier this week, Charles Schwab, a lot of big names you may know out there popping off. Of course, that's going to lead to all the big tech and, of course, the AI names I was just talking about. All these names are going to be popping off very soon. But we're also, Matt, coming hot off the heels of a season which, as long as you guys have been crunching the numbers with us, and as long as we've been talking about this stuff, which goes back a few years now, I can't recall a hotter season than the one we just experienced. It was, I think, a banger by any stretch of the imagination. I think we finished out around 124, maybe 129%, somewhere in that range. And then, of course, that's going to lift our long-term average back up to about 104% out there right now. So very much a banger by just about any definition of the word last cycle. So let's start there, Mr. Matt. Your final thoughts on the season we just witnessed. And then, as we're kicking off a new one, because earnings is endless at the end of the day, what are you keeping an eye out? What are you watching for? Maybe looking forward or maybe dreading in the upcoming season, sir?
Yeah, so what you're talking about is, and when we say bangers, we talk about from a long vol perspective, owning straddles, for example. How did that do? And you're right. I mean, last season, that was the January season, kicked off about the 12th, and goes for 6 weeks plus, was 27% above. I don't think we've ever seen more than 12. So that was a big, big deal. And I think what we're piecing together is vol was relatively low during that period, and earnings then became much more important. People are focusing more on it. So to me, it seems like now for this earnings season that we're about to enter, vol is high. Vol, or at least in what we would call our high middle area, almost going to high. 20 would be high for us. So what tends to happen is earnings becomes less important the higher the vol in the market in general. And so that's what I think is going to happen this at least the first couple weeks of this season, is we're going to see pretty elevated market volatility, and it's going to take away from the performance of the long straddles, because the straddles, instead of like being an average price of about 3.5%, the straddles are now 5%. So this and that's still not implying a higher earnings move per se, because the earnings moves are calculated, as a relationship to other months often. So the stocks are going to have to move a lot more in order to make money in this earnings cycle. And as we've seen in the past, they generally have a tough time. Although I was looking back at I think it was OC 22 when the vol was really high, and that one was pretty crazy. That one actually, straddle owners did okay. So I think we're in for kind of an interesting season. I don't think that it's going to be nearly as profitable to be long, but there's still that residual interest in earnings, and especially the forward-looking comments that are made. So I'm looking for slightly below the nearer to the average that we used to see of about 98%. Currently we're at 99. So we had 103 for the first, and then this first week has started off pretty slowly. Today, for example, was just looking at the stocks that have come out: Bank of America, Johnny John, Morgan Stanley. Those are all pretty low. So they haven't moved a whole lot versus what it was expected. UNH did. UNH had a nice move, but that's about it. So so it's looking like they're going to have a tough time covering, so to speak, this earnings season, Mark.
Yeah, I mean, it's hard to compete with what we saw last cycle. Again, if you want all that data for yourselves, listeners, theoptionsinsider.com is the place to go. Click on the Options News and Articles tab, and you could just lose yourself in the mountains, the volume of data we send you. Trust me, it's a fun ride, though. You want to go down that rabbit hole, especially if you are intrigued by all these things that are out there moving the market day in, day out, certainly on the single name side. As we keep on rolling, kind of an interesting development here, Mr. Matt, that I want to get your thoughts on as we head on into a little bit of Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, let's get to it. A little bit of Options 101, a little bit of a different topic here today, Mr. Matt. We're not going to go over what is a credit spread or anything like that like we normally do, but something that we found to be surprisingly controversial. It's always the seemingly banal things that sneak up on you and somehow really resonate with the audience, trigger a lot of people to comment on both sides of the issue. I remember we did an episode on box spreads a few years ago, and I had a similarly contentious reaction. I was surprised. It's box spreads, the most boring thing on the planet, an interest rate play. And when we debated this last week on our Options Bootcamp show, Mr. Matt, myself, and Mr. Dan, I thought we would have a similar reaction, very kind of open and shut conversation. But no, this actually opened the door to a lot of interesting debate, a lot of feedback from the audience on both sides. Also a surprisingly contentious question of the week. What the heck am I talking about? What is this hot button topic? Is it selling zero DTE premium? Is it something else? Is it inverse vol? Something completely and totally contentious and volatile? No. It is the seemingly simple notion, are options at the end of the day a zero-sum game? And we brought this up because we used to hear this all the time back when we were market makers. We used to chuckle. Notion, options are a zero-sum game. It has to be a winner and a loser on every trade and a buyer for every seller and vice versa. And we kind of laugh because technically the latter portion is true, that of course there is a buyer for every seller. But again, there is clearing in between. There's a market maker there, and they don't really have the same opposite economic intent that you do. They're playing a very different game. And then also, as market makers, as we all knew, we were hedging away the delta risk almost instantly on most of these trades. So we were playing, again, a very different game, a more vol and skew-oriented game than the end retail customer was, which is usually very delta-oriented. So we used to laugh because there are many examples. I'll just give you one, listeners, of where both sides of an options trade can win. For example, you are, let's say, Apple. Apple is trading around 170 right now. Let's say you're bullish in the next month. You think it's going to blow through 180. So you buy the 180 call for, let's say, $1. Let's say it's just straight customer to customer. Let's even forget the market maker side of this for a second. Let's say you're a customer, you're long some Apple stock, and you think, you know what, I wouldn't mind letting my stock go. It's been a good run at 180. I'll collect $1 for that, so I will sell that call to you. So now you have two sides of that trade. Now let's say the Apple closes 183, somewhere 185, somewhere in that range, north of 181, obviously. Now you might say, well, the guy who sold that call loses. But no, of course, he has stock in his back pocket. So he ended up letting that stock that was trading around 170 go at effectively 181. So he wins. He's a happy camper. And guess what? The person who bought that call for $1, they also win. They made $2, $3, $4, $5, somewhere in that range, wherever it closed above 181. And so they both win. That's the same thing with market makers. They have the other side that they're hedging all the time. So there are many examples where they both win, or sometimes they can both lose on a trade. But the notion that options are a zero-sum game seemed to me to be demonstrably false, but it kind of kicked off this hornet's nest, Matt. That's been kind of fascinating to watch. We got a lot of epic responses from our listeners on both sides. We'll get into it in more detail tomorrow on Options Bootcamp, because that's where this debate kicked off. But I wanted to give you a chance to weigh in on this as well, Matt, including, we put this out to our audience, a very simple question. Are options a zero-sum game, yes or no? I thought it would be overwhelmingly no, 99.1%. And no, it ended up coming out pretty close to 50-50, Mr. Matt. 57.4% saying no, 42.6% saying yes. So clearly I underestimated the contentious nature of this seemingly simple question. So first off, where do you fall in this debate? Are options a zero-sum game, and why, sir?
Well, I like to see both sides and argue both sides and then pick the best one. So I think the people that say yes are just saying, well, their options are contracts. For these contracts, there's a buyer and a seller. So clearly that's a zero-sum game there. So that's they're kind of actually technically zero-sum. But, I fall on the no, because especially in equity options, as you say, what people are trying to do, I think, out there, and why options are so successful, because you have an equity market that has a risk profile, and as you see, a payout picture for a stock is just from the bottom left-hand corner to the top right-hand corner of a chart, and options can give you a more tailored risk payoff. And that risk-adjusted returns is really what all investors should be looking at. And so options play a very important role, not just in helping you tailor your payoff picture or your risk, but there's also a ton of information in there that is important for valuation of companies. Now, the embedded option is now extremely important in finance, and that's my background as finance since undergraduate, graduate school, and obviously as an option market maker. And so options are extremely important, and not just kind of written off as a zero-sum game. I could move on. If you do that, you do it to your peril, because there are certainly a ton of opportunities to profit in the option market, but mostly to manage your risk, and mostly to understand the financial nature of options and valuation and the embedded options and so many things out there, not just economic. And that's why I think it's important for the zero DTE, and where I think it's going to go down to hourly, is seeing the risk and what is going on, the implied moves in the market, is important for the entire investment public. So That's where I'd say no to that, Mark.
Yeah, there were a lot of heated thoughts on both sides. It seems to come down at the end of the day, Mr. Matt, to a bit of a 6 degrees of separation / Kevin Bacon argument. How far out do you take the logical side of this? Like people were arguing, well, even the market makers at the end of the day, that's not zero sum because let's say in the case of the call, they sold the deltas, but the person who gave them the deltas, they're going to end up losing. So they're tracing the origin of the hedge, Matt, all the way back to inception. And they say if you trace it all the way to the root of the trade, then it is still zero sum. So I think for clarity's sake, for simplification's sake, Mr. Matt, and also for practicality's sake, the real way these products trade. We got into a whole conversation about stock as well and Delta One stuff. Are those zero sum? I thought that was pretty straightforward too. People were arguing that as well. But the Delta One stuff, I think there's less of an argument for it being not zero sum. But the option side, at the end of the day, practical terms, how things trade. The market maker in particular, which is the other side of all your trades that we're talking about. So it's customer versus market maker at the end of the day. They are hedging this stuff. So there is a very simple way that both sides can win, both sides can lose, or one side can win, one side can lose. There is no exact because the customer won, you lost, and vice versa. So I come away from that saying, from a practical perspective, that it is not a zero-sum game, Mr. Matt. So intriguing stuff. Maybe I'll have to have you join us on boot camp. We can debate it further, Mr. Matt. What do you think?
Yeah, I'd love to. I mean, obviously we were market makers on the floor and thought about this a lot, but there are so many things that tilt that scale. So yeah, I'd love to be in boot camp with you, Mark.
Yeah, then I threw out stock to Dan, and he proceeded to go on a lengthy treatise about how stock is not zero sum. And I was like, wait, what are you doing? You're supposed to be talking about options. So yeah, it was a whole thing. You never know at the end of the day, Mr. Matt, what is going to trigger the audience and really resonate with them. So clearly right now, it is zero sum. So we'll get into this more on Options Bootcamp tomorrow. I wanted to give Matt a chance to weigh in, listeners. But now it's time for all of us collectively on the show to maybe take a breath and then get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market. So we do it for you. It's time to get the buzz.
All right, everybody, it's time to get the buzz. And Mr. Matt, the story that we've all been following, that we've all been watching with bated breath, month in and month out, pretty much ever since, again, the onset of the pandemic, is this notion that can the options party continue? Can this rollicking roller coaster of pretty much mostly upside continue? And the answer pretty much show in, show out, for a better part of 4 years, Mr. Matt, has been yes, a resounding yes, blowing the doors off month after month, year after year, record numbers across the board, until this past month, Mr. Matt, we finally see maybe a chink in the armor, but maybe not. I'll lay some context for you, listeners. You can decide for yourselves. Last month was March. We got the numbers in our hot little hands of our friends on this show over there at OCC. And unfortunately, total overall options volume taking a bit of a hit, Mr. Matt. We were at 1.05 million contracts this time a year ago, March of 2023, 943 million this time of March of 2024. So that's off about 10.4% to the dark side. If you look and see where some of that change up came, equity options were pretty much unchanged. ETF options down almost 22%, 21.7%. Index options down 8.2%. Interestingly enough, VIX futures, which is pretty much the only thing they clear over there on the future side at OCC, down nearly 30%. So that should also tell you that something was afoot last year in March. And that's where we get to the context for this conversation. Because a year ago, of course, listeners, last March, we were in the height of the contagion fears. It seemed like every regional bank was going to go the way of the dodo. So not surprising we would be north of 1 million contracts and that the index and ETF and indeed VIX futures would be booming this time a year ago. So when you see it in that context, it really would have taken a lot for the market to equal those volume numbers. The fact that we got even close is kind of impressive. The fact that we were threatening 1 million contracts in what I would term a relatively, not quite normal, because nothing is normal anymore, but a relatively stable month. There were no crazy contagion fear is on the horizon. That to me was kind of impressive in and of itself. But Mr. Matt, I'm curious your thoughts. I was just looking. It was obviously a down month. I was looking to see if we have a sad trombone sound effect, something like that. We don't really have that. The closest I could find was something like this. That's more of a happy crowd. How about this? That's just weird. So, no sad trombone. I was looking for one while you were talking earlier, Mr. Matt. But so either way, a little bit of a wah-wah this month, or I should say last month on the options front. What do you make of this? Are people reading too much into the tea leaves here? One down month, sir, or is this maybe a sign of things to come?
Yeah, they were reading too much. Last March, I was going to say the same thing you did. I mean, it was so volatile and jumpy, and implied volatility spiked, quite a bit. And we saw a ton of volume. What is that day? Like the 10th market was way down, and of last year, March 2023. So you have to always point out what you're comparing to. So that was it. That was a huge month. By contrast, March was just kind of a grind higher. So the absolute worst comparison on each side, the numerator and denominator, and still was only 10% down. I mean, I think that's actually a win for the option market numbers. And April is going to be a blowout, I think, if you start to look at now all the volatility is coming back and the volume's coming. So and then if you want to slice and dice, ETF options were down the most. Equity options were unched almost to last March. Index options down about 8%. So yeah, I don't read too much into that. I think April is going to be such a blowout. I think we just continue to see growth in options. I've talked about it before. I mean, zero DTE is really helping the whole complex by making the markets what I think is more liquid, and because the market makers, again, they have healthier positions that they're carrying out there. So I think the band keeps playing on, Mark.
And you're right about the volume in April. Just some quick nuggets. We'll get into this more obviously next episode when we have the total data for April. But right now, mid-April, listeners, VIX volatility options blowing the doors off. Highest volume level since February of 2018. Now, why is that date significant? If you're newer to the market, it may not resonate with you, but that is the month known as Volmageddon in many circles, where the infamous XIV went to die and vol exploded and all sorts of madness unfolded in the volatility market as a result. Now, I say that with a bit of a caveat. SIBO's beating that drum, but if you look at the actual numbers, it was impressive. It was 2.61 million. This was last Friday, April 12th, listeners. But still, it's I won't say half, but it's about 60% of the volume that they put up back in February of 2018. So again, it's an impressive number, the highest since that date, and maybe a sign of things to come, but perhaps not as dramatic as it sounds. But still, intriguing stuff, and maybe a sign that what Matt was just saying is indeed true, that April is trending towards the hot side from a volume perspective. Speaking of volatility and trending towards the hot side, or maybe the not side, I'll let you decide, Mr. Matt. We had also on the vol front, in the buzz since our last episode, again, a product some of you may know and love, others may not like, which is, of course, UVXY, the infamous inverse vol product. It's 1.5 levered VIX. If you want to know why it's 1.5 levered and not 2, you got to go back to Volmageddon 2018. That's when that happened, listen. That's when that product was effectively neutered and has been at about 1.5 leverage pretty much ever since out there, listeners. And so that one, of course, as it is wont to do, ever eroding, got down below 10, got to around 8 or so, and they decided to reverse split it. Kind of a paltry 5-for-1. I was not that excited, but you take what you can get out there. They did this on April 11th, Mr. Matt. We were kind of tepid on it. Again, a UVXY close to a 40, certainly more exciting than a UVXY around 8 or sub 8. I'm curious. I know in the past you've been, I think, fair to say, a little bit reticent on these products, these Frankenval products out here. Does this reverse split, did you notice it? Does it excite you? And does it make you maybe reconsider your approach to UVXY, sir?
Yeah, Mark, you're right. My approach to these is it's hard to get on a level playing field with some others in these markets. They just know them so much better. The ETF backers for these are sometimes a little bit squirrely, meaning they don't back them that well. They let them go sometimes, as we saw in Volmageddon. And frankly, just being in the offices of some of my clients that are very smart, they knew so many more nuances of these types of ETFs that I'm just like, I'm never going to trade that because you're trading against really the house, and the house knows a lot more. So I don't pay a whole lot of attention to that. My approach to trading is a lot different than you concentrating on these types of ETFs, Mark.
Yeah, they're fascinating to watch. Listeners, does this reverse split back up to around a 40 level? I think it's back to about a 38. Actually, just rallying a little bit towards the end of the close here, back to 39. So still hovering around that 40 level. Does it make you excited? Not excited for this product? It certainly is a more tradable product, I will say, at a 39 or 40 than around an 8. So if you were waiting for that moment, perhaps this is your time. Speaking of moments, now is your time, listeners. It is time for the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Let's get to it. Mr. Matt, first, let's check in with our audience. And unfortunately, sir, they are, as probably expected, they are leaning to the upside. More of them have surged in since earlier in the episode. Now a full 73.3% are going the 5,500 route, Mr. Matt. Only 26.7% for the S&P 3,500. Sir, how does that make you feel?
I like to see the believers there, Mark. So there's still some, we wanted odds, but it's good to see the true believers on the dark side there.
If we had done 4,500, might have been maybe because that's close to 50-50 at that point where we are.
I think you would have gotten more in the 4,500. That
might have been interesting. We wanted to keep it spiritually similar to your previous 3,000 versus 5,000. Maybe we'll go. Maybe for a follow-up, maybe we'll do 4,500 versus 30. Or
6,400.
6,000, 4,000? Oh, we could do that too. Yeah, okay. We could go many ways around this, listeners, as we keep carving this onion out here. Also, right now, our other question of the week, which is still going, the Fed versus the AI revolution in terms of the biggest driver. Just ticking again as well, 47.4% each now, so an exact tie for our audience between the Fed and AI revolution. 5.3% only for others. So clearly a contentious issue there between what is the key driver out there in this market. And let's get out of here, Mr. Matt. On this question, I like the handle, Don the CFA. Wonder what he does for a living. But Don the CFA writes in, he says, hello. Well, hello, Don. He says, greatly enjoying the program. I wondered if the host, Matt Amberson, could provide a little more detail on his hedging technique using out-of-the-money put calendar spreads from episode 127. I find it fascinating, and I'm trying to determine the proper use case for my clients. Thank you very much. Well, if you did miss that episode, listeners, as you mentioned the number, go check it out. It was episode 127 called Low Vol Calendars Plus the great, again, we talked about it then too, the great 3,000 versus 5,000 debate. So we've been on this tip for a while. That came out all the way back July of last year. Seems like we did that more recently than that, but yeah. All the way back in July of last year. So intriguing stuff out there. But yeah, all the way back to July, listeners, for that episode 127. Since then, Mr. Matt, Don the CFA, has been listening and trying to figure out what the heck you were talking about and how he could utilize it with his clients. Obviously, we did a whole episode on it, so you don't need to repeat the whole thing. He can check that out again. But maybe any nuances, any specifics you want to add to maybe improve clarity for people, sir. Have at it.
Yeah. So if you think about the payoff picture, it's like a tent. Okay. So it kind of goes, you're losing on the wings, and then right at the calendar strikes is where you want the stock to go. Now, if you move that tent down to the left to the lower strikes, you kind of, what you want to see is the market going down. Now, if it goes up, you're short the front month, and that's kind of decaying away pretty quickly. And so, for hedging a position, you still have that nice tent down there. And also, if the vol goes, or sorry, if the market goes down towards it, you might say, well, you're short that and you're long one. So, what's going on there? You could say, well, volatility will rise, and then that long will really outperform the short. And so that's why I've been really liking the calendar with our, so the calendar. So that's, so there's a long put that's really expensive, and that you would have gotten, lost a lot of money on this rally. There's a put calendar that you lose a little bit, but you still have a lot of protection down there. And then there's a diagonal calendar. Well, that's what it is, but a diagonal, which is a calendar with a little bit of a vertical. So you're selling a more in the money, closer to the money, and you're buying a farther out of the money. And with that diagonal, you could do it for almost even. So even if the stock goes way up, you're not going to lose that much. But as it goes down towards your diagonal, you have to be a little bit careful not to get too close to your short, because you're short that kind of vertical there. That's when the volatility really helps out. So that's the way I've been playing it, especially during this rally. When our signals are strong, I do the diagonal. When our signals are medium, I do the put calendar. And lately, I've been buying straight puts. So so those really pay off, but you have to be very careful with those. So that's the way I do it. And I should point out now, I think it's a good opportunity, Mark, just to talk about an approach to trading that we follow, and why we've built all our tools towards this. It's a 4-pillar approach. It's research, it's implementation, it's risk, and it's review. Those are the 4 pillars. And you really have to find your niche out there. In order to be successful, you got to find where you fit in. And it takes a lot of work. And the people that put in the work are the people that are profitable. And the research is the start. I mean, the research is having very good data, having very good tools to back test and check out your very good data, making signals. So that's kind of the research pillar, number 1. Number 2 is having a very good execution and implementation of your strategy, whether it's systematic and black box to using scanners. And for ORATs on our dashboard tool, obviously we have great research, but we also have connectivity to a lot of the big brokers out there, so you can implement your strategies well. And then we're also building automation. Like, we have a lot of exit alerts. So when should you get in? When should you go out? And a lot of that is in the back test. So that's the second pillar, is implementation. Third pillar is the risk. So we bring in the positions from all your brokers. So I have like 4 brokers that I could just switch between and see all my risk. The slides, how much do you make on a 3 standard deviation move to the upside, the downside? You combine them all. So risk, super important. And then one that we're building and is equally important is review. And we're building a journal. So that's going to be the next thing, Mark, is a trade journal. So you could see, where you've made money, what types of strategies, how much slippage you've had, what you were looking at when you made trades. All that stuff goes into the review. And that's about finding your niche. You might look back, hey, I made all this money on this type of strategy, or I made this type of money on this strategy during this time in the market. So I think it really takes a strong approach to trading in order to be successful. And at ORATs, we follow the 4 pillars. We also do a lot with education. We've now added a community to a feature for chatting, or it's about to go up to our ORATS dashboard, which is our tool set. So, and that's your ability to bounce ideas off of other people, how to use it and such. So I think these are great questions that we're getting from your users. I don't want them to make it seem so one-off, because my trading is part of a holistic approach that involves using the 4 pillars. And I think that's what you need for success, Mark.
All right. That music means we've come to the end of another epic journey through the world of advisors and options. Just checking in last bit. Yeah, we're at 75% now, Mr. Matt, going to the upside. But hey, take solace in the fact 25% of the audience siding with you, sir. So there you go. You got a core 25% that are sticking with you through thick and thin to the dark side of 3,500. We'll revisit this on future shows. Should be fun. You mentioned the journal. You mentioned a lot of the other data you folks have cooking over there in the land of ORATS. If folks want to go check out that kind of stuff for themselves, where should they go? What should they do, sir?
Yeah, come over to ORATS. Like I said, we're adding all the time. Our market intelligence is really cool. I could see United Airlines is up 4.6% in late trading. What else is going on? These are the earnings for tonight. And then we have, of course, the journal. We have so much going on, back testing and time and sales and all this stuff. So you could email me at Matt@ORATS. Come on over to orats.com, see what's going on, and maybe even join our new community that's starting up. Be one of the first to join. So yeah, it's a lot of fun over here, Mark, and we're really excited for the rest of the year.
There you go. Check them out over there, orats.com, ORATS.com. Check out their community and give them a follow on the old Twitter as well, @OptionRats. Give them some support as he is currently losing in the battle in our question of the week. And you know where to go to check out everything cooking from our friends over there at the OCC. It's just optionseducation.org, all in one place for you to go. Check out that advisors tab. A lot of great research there to help arm you when you're sitting down with your clients, some studies, some data, all the things you need to know at the end of the day. And that is going to do it for us on the network today. Back again tomorrow with our buddy Mr. Dan to maybe go into more detail, round 2 perhaps, of this epic options as a zero-sum game debate. Should be kind of fun. Maybe we'll drag Mr. Matt into it for a triple threat match. How about that? And then, of course, back again on Thursday for our doubleheader of This Week in Futures Options, as well as the Option Block Friday vol views. And then, of course, after that, for our friends on the pro side, theoptionsinsider.com/pro. We're back again to end the week with a little bit of options oddities. Then we're back again next month with another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.